Good morning and happy Tuesday. So glad you're here. Welcome to Market Sunrise. Let's get you fully locked in on everything that matters before Wall Street opens for the second half of 2026. Quick reminder, nothing you hear today is financial advice. I'm here to inform, not to tell you what to buy or sell. Let's stick around, because this first trading day of the new half has some very big numbers to unpack. Let's dive straight into U.S. news, where the bulls closed out the first half in style. The Dow punched through 52,000 for the first time ever, closing at 52,319, up 136 points, or about 0.25%, to cap a milestone Monday. The Nasdaq was the real star, surging 1.5% to 26,214 on a tech-fueled rally, while the S&P 500 climbed 0.8% to 7,449. But overnight, the mood has cooled. S&P futures are down 0.3%, and Nasdaq 100 futures are off 0.6%, as traders take some chips off the table to start Q3. That softness is showing up in the big ETFs too, with SPY slipping to 745.42, down about 18 basis points, and QQQ pulling back harder to 732.45, off more than 0.5%. And just to put a bow on the first half, what a run it was. Now here's what makes this rally so interesting beneath the surface. The Russell 2000 absolutely ripped in the first half, gaining roughly 22% for its best H1 performance since 1991. Small caps are back in a big way. Treasury yields climbed on the back of strong labor data, with the 10-year pushing to 4.44, up 6 basis points, while the 2-year sits at 4.15. The JOLTS report came in hot. May job openings hit 7.6 million, versus the 7.3 million estimate, showing the labor market still has plenty of juice. The long end felt the pressure too, with the 30-year yield climbing 6 basis points to 4.93, knocking on the door of 5%. Meanwhile, inside the tech trade, there's a fascinating rotation underway. Let's talk about who's winning and losing within the AI theme. Memory chip makers stole the spotlight in Q2, with Micron, SanDisk, AMD, and Marvell leading the charge, while NVIDIA actually lagged. A real changing of the guard within the AI trade. Wharton's Jeremy Siegel is calling for a broader rotation out of mega-cap tech into cyclicals and value names, arguing the easy money in the biggest stocks has been made. And if you're wondering about the Fed, the market sees them firmly on hold at the July meeting, with Fed funds steady at 350 to 375. Now, let's check the market's fear gauges, because this is where it gets really interesting. The VIX sits at a relatively calm 16.5, up just 0.4, but the Fear and Greed Index has dropped to 27, which is solidly in fear territory. That disconnect tells you options traders are complacent with stocks at record highs, but under the hood, momentum, breadth, and crypto weakness are flashing caution signs that not everyone is celebrating equally. All right, let's shift to deals and catalysts, because there is a lot of corporate action this morning. Bloom Energy just massively expanded its data center financing deal with Brookfield from $5 billion all the way up to $25 billion to power the AI infrastructure build-out. Alcoa is going on offense, agreeing to acquire South 32's alumina mines in a $4.1 billion deal to lock down upstream supply. Belgian group Tessenderlo is taking a roughly 20% stake in FMC, investing $400 million at $13.30 a share in what looks like a strategic bet on crop chemicals. Constellation Brands raised its fiscal 27 guidance after a strong first quarter, showing that the beer and spirits giant's premium playbook is still working. And in European aerospace, Safran is acquiring underwater tech firm Exhale Technologies for €2.19 billion to bolster its defense portfolio. One more deal to flag before we move on. UK private equity firm Bridgepoint is snapping up Kayne Anderson's real estate platform for $1.39 billion, adding U.S. property exposure to its alternatives business. Now let's see what the analysts are saying this morning. Some big price target moves to walk through. Macquarie just jacked up its CrowdStrike target from 400 to 660, while keeping a neutral rating. That's a 65% hike, signaling they see the cybersecurity leader's valuation catching up to its growth story. BTIG raised Guardant Health's target from 160 to 190 with a buy rating, reflecting growing confidence in the liquid biopsy pioneer's commercial momentum. On the downside, Telsey trimmed Nike's target from $55 to $47 with a market perform rating. And we'll talk more about Nike's earnings in just a moment. UBS lowered Medtronic's target from 90 to 85 with a neutral rating, suggesting the medtech giant still faces near-term margin headwinds. And KeyBank cut McDonald's target from 330 to 315, while keeping an overweight rating. Still bullish, but acknowledging the consumer spending slowdown. One more analyst call worth highlighting. William Blair upgraded Karat Packaging to outperform, betting that the sustainable food packaging company is entering a stronger growth phase. Let's take a trip around the world and see how global markets are setting the stage. Japan's Nikkei keeps grinding higher, adding 0.6% to close above 70,475. That index has been absolutely relentless. The rest of Asia finished mixed on the last day of Q2, with Hong Kong's Hang Seng jumping about 1.6%, and China's CSI 300 gaining 1.2%. South Korea's Kospi was the outlier, slipping 0.2% as chipmaker profit-taking weighed on Seoul. Europe is treading water at the half-year mark, with the Stoxx 600 flat and Germany's DAX edging down 0.2%. UK stocks drifted lower as well, with the FTSE 100 off 0.2% on cautious quarter-end positioning. And one geopolitical headline to keep on your radar from the global stage. Iran has ruled out any direct negotiations with Washington, insisting all communication must flow through Qatari mediators, a development that keeps Middle East risk premium alive. Now let's hit the earnings that dropped overnight. Nike beat on the bottom line with adjusted earnings of 20 cents versus the 13-cent estimate on revenue of $10.97 billion, but the stock is still trading down 3.5% pre-market, a classic case of investors looking past the beat and worrying about what's ahead. Let's check in on commodities as we kick off the new quarter. WTI crude is under pressure this morning, trading around $68.79, down a full percent as demand concerns weigh heading into the holiday-shortened week. Natural gas is holding steady, with Henry Hub averaging around 3.34 per million BTU for the second half of 26, supported by summer cooling demand. Gold is pulling back from recent highs, trading around $3,977 an ounce, down 0.7% as rising treasury yields draw some capital away from the yellow metal. Here are the names leading the charge in pre-market trading. And on the flip side, these are the names under the most pressure right now. Before we wrap up, here's what you need to have on your radar this week. It's a packed calendar. The June jobs report drops this Thursday, July 2nd, one day early because of the holiday. And given how hot jolts came in, this number could move everything. Keep a close eye on the Iran-US talks situation and any developments around the Strait of Hormuz. That's your wild card for oil and defense names. The next FOMC decision lands July 28th and 29th, And while the market expects a hold, the data between now and then will shape the September conversation. ISM manufacturing hits this week, along with a run of economic data that will tell us whether the economy is cooling or still running hot. And don't forget, Thursday, July 3rd is a shortened trading session ahead of the July 4th holiday, so expect lighter volume and wider spreads. A couple more items to keep in the back of your mind. Watch for tariff and IEEPA refund disclosures as companies report. Those one-time items could meaningfully distort earnings comparisons this season. So here's the big picture as I see it. Stocks are walking into the third quarter at all-time highs after the best first half since 2020, and that is genuinely impressive. But futures are pointing lower this morning as firm yields, that Iran headline, and some healthy profit-taking invite a breather. Thursday's jobs report is the swing factor this week. If it comes in hot, expect yields to keep climbing, and that would put real pressure on the richly valued corners of tech. The key question for Q3 is whether this rotation into cyclicals and small caps broadens the rally into something more durable, or whether the mega caps reassert their dominance. Either way, it's going to be a fascinating second half. Now let's check in on crypto, which is telling a very different story right now. Bitcoin just logged its worst month since 2022, sitting around 58,500 and down another 2.6%, not where the bulls wanted to start the new quarter. Ethereum is in even rougher shape, sliding below 1,600 to trade around 1,570, down 2.5% and struggling to find a floor. And here's a stat that really captures the mood. Spot Ether ETFs have bled $274 million over just 5 sessions, with not a single positive flow day, which tells you institutional appetite has dried up. Here's a quick look at where the major tokens stand this morning. Stepping back on crypto, it looks heavy heading into July. Bitcoin just posted its worst month since 22, and Ether is leaking ETF flows without a single positive day in the last week, which is a clear sign that risk appetite in this space is running thin. History from 2018 and 2022 shows us that a weak first half hasn't reliably bounced in the second half, so momentum remains a headwind here. What would change my mind is a steadier dollar, calmer treasury yields, or a genuine pickup in ETF inflows. Those would be your first signals that a base is actually forming. If this briefing helped you start your day sharper, do me a favor. Hit that subscribe button, drop your boldest Q3 prediction in the comments, and ring the bell so you never miss a morning with us. And one final reminder. Everything you heard today is for informational and educational purposes only, not financial advice. Always do your own research and consult a professional before making any investment decisions. And we'll see you right back here tomorrow morning.